So we'll try again 呢。New stream， 哎呦，我按了就 New stream。Send me ultra view ID。
New user get 8% off hotels. Book your luxury hotel stay on.
Hello， 朋友们，现在站在我身旁的就是全世界最大的。
主要本吗 ？Ultra view。好像要重新用过。
对。主要跟你的吗？
好像重新 create 过一个新的。刚刚。
Not now.
Start the stream. Wait, start already. According to here can speak. 现在问题是我刚才按掉了，他还给我播放吗？中午开不了这个。可以寄回去的，
可以吗？
好像不能。View your channel live， 现在这个 live。他在动吗？
还在send这个，直接send这个。
你想说啥这个？
我在想，我们要不要把这一个东西学出去的？
直接进 Teams。
直接进 Teams 上，然后这边好了的话，就两边走了。 Hold on. Typo, which one?
我要做新的 link。哦，要做新的 link 没有办法了。
给那个 link 我了。
好像是开始了。share copy。Okay, Bursa already. I'll share the link again because we open up a new link.
什么啊？
你 live 了 OK 了，可以申请了，
有声音
全部。OK 了。
苏令，你 start 一下看。他讲好
start
了。
了，我 start 了，我 start 了，我 start 了。现在是播这个选。
你播着那，可是你是 new link 是吧
是的。
I think
？Exactly，要去。
I share already.
Okay.
Okay, finally. Alright. Okay, can. So sorry everyone. We start over again because the link has just expired just now, and then so we started again our webinars in the introduction part. Okay, so welcome back to our Apex Derivative Trading Challenge webinar series. So today marks the day 5 of the webinar series, and I'm Suling, your host for these sessions. So so I just straight away move to our main part already. Alright, so today the topics, the psychology of trading and trading for a living by Mr. David Ng, who will be sharing valuable insights into how mindset play critical role in trading success, as well as what it takes to make trading a sustainable career. Alright, so before we start, as usual, so today's session is purely on educational purpose. There's no buying or selling advice, and please understand the risk involved in futures trading, and also seek an independent financial advisor for investment decisions if you like to make investment decisions in trading futures. Now let's move on to our speaker introductions. So tonight we are honored to have with us Mr. David Ng, a seasoned full-time proprietary trader in Iceberg X Berhad, a local proprietary trading firm based in Kuala Lumpur. So David brings a wealth of experience in trading commodities and indices with a strong focus on Malaysia's index and crop palm oil futures. He has a solid background in research and is known for his sharp market insights. Before his current role, David led a young and dynamic team at a prominent local brokerage, actively promoting futures and derivatives to Malaysians public. Many of you may also recognize him from his popular seminar and market coaching sessions, where he has helped countless individuals begin their trading journey. In addition to his on-the-ground trading experience, David is a regular contributor to The Star, Business Time, and The Age, offering market commentary and insights. And academically, David holds a degree in economics and business study from the University of Manchester, and he is also a chartered market technician (CMT), a testament to his technical expertise. So without further ado, let's give a warm welcome to Mr. David Ng as he shares practical trading strategy and discuss the psychology of trading and what it truly takes to trade for a living. So with that, I will pass the mic over to Mr. David.
Yeah, thank you, Suling. Just a quick sound check. Can you hear me?
Yes, I can hear you. I stop
Okay.
sharing here and then you share your slide. Okay.
Yeah, next bit, I would just need to ask you, can you even see my slides?
Yes, I can see your slide.
Yeah, okay. Now it's on full screen, right?
Correct. Full screen already.
Okay, yeah.
Okay.
Good to go. Yeah, okay. So yeah, thank you everyone for joining tonight's session. So this is part 2. If you can recall, you have joined us for the first session. I talk about mainly on how to trade the Bursa Malaysia market, mainly the FCP and FKI. So today I'm just going to touch a little bit more on how to manage your risk and what it takes to become a trader. Whether is this so-called journey or profession be the right one for you, and obviously there's much less talk on psychology of trading, which I think is an important element for trading success, which I'm going to touch a little bit more on today's session. So today is mainly more focusing on how to manage your risk and the importance of trading psychology. And if you're taking this path to trade for a living, I think it's a good opportunity for you to be participating in the Apex Derivative Challenge. I think it's a good platform. If you are new to the futures market, you're not sure how to kickstart your trading journey, participating in this trading challenge can actually be a good start for you. Just to measure yourself whether this is a journey that you want to take. And obviously, trading, practice, it requires a lot of practices. And I think trading challenge is one good practice or one good way to practice your skill and your ability. So as usual, I think the risk disclaimer, I just to reiterate what Sulang has mentioned just now. This is purely for educational purpose. So any material that's presented here is purely for education, and any opinion that's presented is basically my own opinion, doesn't reflect any opinion, whether it's from Apex or whether it's from the exchange itself. And do mind you, I think trading in futures market or trading in any form of derivatives, it involves a lot of risk. So make sure you are well accustomed. I believe you're in good hands. You want to find out more about how to kickstart your trading journey, how to open an account. I believe Apex, you can speak to people from Apex. They are more than happy to help you in this area. So make sure you consult a licensed individual, and make sure you have sufficient knowledge before you actually embark your journey into futures trading. Now, I think this is the agenda. I think for the next 45 minutes or an hour or so, this is what I'm going to cover. I think mainly looking at things in a more subjective manner. I think we have touched a lot on in the first part of this webinar session. In the previous, what we discussed is mainly looking at objectivity on how we approach trading, mainly talking about fundamentals on market, using fundamental analysis, then incorporate technical analysis to time your entry and exit strategy. And I think this time around, you look beyond things, beyond objectively. We look at trading in terms of more subjective manner, looking at what it takes in order to become a successful trader. Trading psychology is truly something that you have to grasp. And I believe it's a skill, and it's not really something that is only available in certain successful individual. I think everyone can practice trading psychology, and if you get it right, if you master the strength to have a mental resilience when it comes to trading per se, I think you can definitely go far in your trading journey. So obviously there's a lot of trading biasness in terms of this is more of mental and mental biases where when you come across trading the market, there's always certain biasness that you are accustomed to. So I think I just want to explain to you what are the common bias that is surrounding the market and how we as a trader can overcome these biases, because mental biases are very common, and if you don't acknowledge and you don't overcome it, it can actually affect your performance in the long run. So understanding, acknowledging it makes us more aware, makes us self-aware of our biases, and from there we can actually maneuver and tame those biases, so in order that you are able to form a better analysis, and from there you can actually perform better when it comes to trading markets. Now, risk management is always important. I've mentioned this in a couple of my webinars. I always emphasize this, the goal of a trader is not to make money only. It's always about managing risk, because once you manage your risk, your profit will eventually come. But manage your risk, because risk, if you don't manage it well, it can ruin a trader. And majority of those traders who can't see a career in this is mainly because the risk management is out of place. So have a proper risk management in place and emphasize the importance of risk management. It's important journey. It's part and parcel of a journey. If you want to go for the longer run, especially in this industry. Now, trading journey is not an easy journey. I personally has encountered many challenges along the way. I've been doing this full time almost 7 to 8 years now. So trading journey itself is a very long and arduous journey. So understanding yourself is very critical before you actually thinking to embark on this trading journey on a full time basis. So I'm just going to share a little bit of my experience and obviously let the audience know what it takes to really become or at least try to gain a bit of success or gain a better odds of a success in this trading journey. Now, there's many types of traders. You can definitely be a fundamental trader. A fundamental trader looks at things more fundamentally. So if you are trading SCPO and FKLI, it means you're looking at factors that drive prices. For example, SCPO I mentioned in the previous session is always talking about supply and demand. So as long as supply is tight, prices will go up. If supply is abundant, prices will come down. So as simple as that, basic economics. So for FKLI, for example, what drives prices usually be geopolitics. And for Malaysia per se, it's always about fund flow. If foreigners are coming in, normally that will drive FKLI performance and even ringgit strength. So we've seen how ringgit has performed quite strong lately because of the weakness of the dollar. Actually, that also propagate why FKLI actually been hovering above the 1,500 mark for quite some time. So fundamentals traders are traders that actually look at fundamental cues of factors that drive prices, and that will be the element or basis of their trade. Now, technical traders are mainly looking at charts, can be charts, indicators, tools. So mainly those are instrumental. I also shared in a previous session looking at things on looking at charts, looking at Heikin Ashi, looking at moving averages. These are some of the technical tools that you use normally if you want to find entry and exit strategies accordingly. So technical traders, they tend to put more emphasis on chart instruments as a way for them to make decisions. Now, sentiment trader is slightly different. I think this is a new breed. Sentiment trader combines a little bit of technical and fundamentals, whereby they'll be looking at where the sentiment of the market is. Sometimes markets move in momentum and market trends. When market trends, normally there is always a news that drive them. For example, recently you notice that CPU prices actually been very weak, trading below the 4,000 mark, mainly because supply is coming back, fundamentals is weak, and also look at in terms of technical per se, as long as 4,000 the psychological level is broken, market is heading for a downtrend. So sentiment traders are mainly looking at both the fundamental and technicals, and they interplay between these two concepts altogether when they make decisions. Now, swing is looking at where the high and lows of the market, and also many very chart driven. So they look at where prices is and where the high and lows, and try to establish accordingly where the market might move. And if you talk about duration, I think swing trader usually hold positions at least more than a day. So they are definitely not intraday traders. Now, scalpers are very different breed. That means they are looking at traders who trade on the seconds or minutes time frame. So they're in and out very fast. And scalpers their intention is just to only make a tick or two. As long as market is active, there's a lot of liquidity, and they only matters time frame that is lesser than even 5 minutes. So scalpers are really individual traders that really look at things on a very minute basis when it comes to time frame. Now, intraday traders, basically myself, or pretty much those category of traders that look at trades that's if you open a position during the start of the day, start of the trading session, and you look at you should close your position at the end of the day. So you are looking at for short-term trends that can appear in the market, in whether it's SCP or FKLI. Now, position trader is slightly different. It's looking at things more on a longer-term time frame. So it's if you see there's a particular trend is forming, and usually you tend to those traders who are position traders, they tend to hold positions, especially more than a day. And if there's trend in the market, the observable trend in the market, you'll probably be riding those trend right until the trend has exhausted itself. So position traders usually are more longer term in nature, so they tend to hold positions more, at least more than a couple of days. Now, I just want to recap. So these are some of the fundamental factors that are affecting CPO prices. Just to let the audience know, if you forget what I mentioned earlier in the first session, just to recap some of the key factors. So if you are trading the CPO market, these are some fundamental factors that is worth to pay attention. So you can't run away from supply and demand. If supply and demand is bullish, which means that you have low supply, you should see prices very strong. Watch out on soybean oil. I think lately palm oil price actually been very weak because it's affected by soybean oil. So these are the few factors that you should pay more attention to, especially when you're trading the CPO market when it comes to factors. Now, FKLI is very much driven by external forces as well as also internal forces. External forces always talk about how US market. If you notice, I think lately US market has actually been trying to recover. You've also seen that overlapping into the FKLI performance as well. So US Dow Jones and FKLI futures indices, they share a bit of a similarity in that sense. But again, you can't use that basis just because US today goes up, you expect FKLI tomorrow to open higher. Not necessarily. There's always a period of time where actually they don't follow. So these are the things that we really need to careful, and these nuances that we really need to be aware of, especially when you trade the FKLI market. So ringgit strength, to me, I think the biggest factor, if you look at this list, the foreign inflow is a major factor for now. So you want to see where FKLI can perform. What are the fundamentals driver? Always look at foreign flows. If foreign flows are not coming in, you don't expect FKLI to do well. So these are the things that we really need to be aware of, especially when you're trading the FKLI market. Now, I also touched on looking at things technically, so I just want to recap on how we look at technical strategy. Just to put a disclaimer out, I'm more of a trend trader. So when market trends, usually we try to identify which direction the market trends. And to do that, there's many ways. One is to look at things visually, whether is the market making higher highs and higher lows. That usually be an uptrend market. Lower highs, lower lows, usually is the downtrend. And obviously, if the highs are not going anywhere, the lows are also not going anywhere, it's a sideways market. And in sideways market, I always emphasize this, don't go and do trend trading, because sideways market, you do trend trading, you are just going to get a lot of whipsaw. So, always apply trend when market is trending. Now, I'm a firm believer in Heiken Ashi. So Heiken Ashi candles are very good trend tool. If you compare to Japan's candlesticks are more of reversal by nature. So Heiken Ashi candles are very good tool to use, especially when you look at trends. So you couple Heiken Ashi, you can incorporate moving averages or DMI crossover strategy. Now, you can use both, but I'll recommend that you can use either one. You can use moving average or the DMI, because both DMI and moving average, they give the same signal. So there's no point using indicators that give you the same signal. It gives you overlapping signals, and it will confuse you eventually. So if you are more comfortable using moving averages, just stick to that. If you don't use moving averages, you can obviously use the DMI indicator for crossover. But the main reason of using DMI, just to recap on the reasons, is to mainly to look at the ADX value. Now DMI, there's three lines in total, but the most important one for a trend trader is always the ADX. Now ADX measures the strength of the trend. So you look at the trend, you understand the market is going up, it's an uptrend market, but you need to understand how is it strong or not. Is the uptrend still persisting? If the uptrend is weak, the ADX will show. So if you recall, any value of ADX that's below 25, there's no trend. And if the line of ADX is coming down, especially during an uptrend or downtrend market, it's actually the time for you to be out of the position. So ADX is an important indicator, I would say, for determining the strength of the trend. So it's important if you are looking at trends to have ADX value as a measurement. Last but not least, I also mentioned about using ATR to set your profit target and stop loss level. So that's very key. So just to illustrate this again, so here you can see why this is a sell or is a short signal, because you look at the bars in Heiken Ashi, it's red, and the body of the bars are white. So it's telling you that this market is actually going to come down. And you look at the moving average crossovers, it's actually a bearish crossover. So it's telling you again that look, price is getting bigger, and it's definitely going to hit even lower. Now you look at the bottom panel here. This is the DMI. So again, if you look at the DMI crossovers, these are bearish crossovers. But the black line is what is more important for me. You look at ADX, the black line is rising, so it's telling you that this downtrend might have momentum. So if you apply this third panel here is ATR. ATR stands for average true range. So it stands for there's 25 points as your range of the particular period. So to set your target, you short at 39.72, your ATR value is 25. You work on a risk to reward ratio of 1 to 2. Then you're looking at 50 points of profit, 25 points of stop loss. So that's how you manage your target profit and stop loss accordingly. So just to re-emphasize again, ATR, when markets are volatile, it can go very high, it can go higher value. So that means you have to be more comfortable with putting a bigger buffer to manage your loss. So that's one, I would say, disadvantage of using ATR. But the key thing of all this is that you must have a way to manage your risk. In case the market go against you, you're stop out. So setting your ATR value or setting a lower value compared to ATR will probably be meaning that you probably will get stop out quite often, and sometimes it's very frustrating if the market stop you out quite often and the market go with your trend. It's actually very, very frustrating in that sense. So always make sure if you follow ATR, you're giving a buffer of the day's range. So in a sense that you give yourself a bit more room. But keep in mind, more room means you must have the appetite to take a larger risk in case because markets are more volatile. So do take note of that if you're using ATR. So this is an example of FKLI. Again, the same principle. Heiken Ashi bars. This is a very classic example of taking a long position because Heiken Ashi bars are green, so it's telling you that market is poised for an uptrend. Again, now this is why it's interesting. The ADX is still flat, but you can see the signs that ADX is going to rise, despite there's a bullish crossover already indicated on a DMI indicator. So I think that's a good entry for taking a long position. So I'm not going to go to recapping on all the ways and steps to determine your target entry and target loss. So that's already explained in previous session and previous slide as well. Now, I just want to focus on looking at what is the optimal risk to reward ratio. Now, a lot of people has a lot of debate or opinion on this. Now, to have the optimal risk to reward ratio is very individual. Now, again, I would say it really depends on the style. So I mentioned earlier, whether you are a day trader, you're a swing trader, you're a trend trader, which is more longer term by nature, or even you're a scalper. Now, scalper, it is a very, I would say, it's a very, you usually tend to have very low risk to reward ratio. That means sometimes, the ideal is one point of risk, 1 point of reward. That's the worst situation that you want to be. But sometimes scalpers, they usually work on less than one to one risk to reward ratio. Reason being is because they usually be in and out in the market very promptly. So that means their win rate could be very high in order for them to break even. So risk. The problem by setting risk and reward ratio, because this ultimately will determine your win rate as well. So you can have high risk to reward ratio as long as your win rate is comfortable. If you have very low win rate, you have to make sure that you have a high risk to reward ratio. So normally, if you want to determine the optimal risk to reward ratio, you'll make sure that whether you are doing day trading or whether you're doing more of a longer term by nature. So longer term by nature, normally you make sure that you have a bigger reward profile. There's no point, if you set your time frame so short, but your reward is very small. So as a guide, if you're day trading, normally you look at between 1 to 1.5 reward, or even 3 times reward. If you are doing swing, normally you look at 3 to 4 times of reward. Now, trend following, normally you expect even more because you're holding into the whole trend. So the whole trend can probably last you for a period of time. So normally you're looking at least 3 to 5 times of reward against one portion of risk. So that's how you work on your risk to reward ratio. It all depending on the style of trading that you comprehend. Now, keep in mind, risk to reward also depending on your win rate. Now, if you have, if you have a very big, the common notation is willing to risk 1 with a reward 2. It usually allows you to have a lower win rate. So, example, if you have a win rate of only like 30% most of the time, you can work on a 1 to 2 ratio. Then obviously, when you have higher risk to reward ratio, your win rate can get even lower. But importantly, it all suits to what style of trading that you are ultimately going to do. So if you are looking at doing trends, then you are prepared to have a higher risk to reward ratio. Now this is just a guide. I think if you look at it, the moment when you have higher risk to reward ratio, technically you can have a low win rate because again it all depends on you can risk more, but your your win ratio is going to be very high. So it very much depending on the style that you intentionally want to do. Now I won't encourage for any risk to reward that's lower 1-to-1 because that eventually means that you really have to work on a lot of trades in order for you to break even. So always make sure if you are doing trend trading, I think it's ideal enough to work on 1 to 1.5 in terms of reward, or even in fact try to aim for 1 to even 3 times of reward. So that's the ideal situation. But again, this is only depending on market conditions in a trendy scenario. If the market is not trending, the market is going sideways, it's very tough for you to do any reward ratio that's 1 to 1.5, or even talking 3 times is going to be quite difficult. So always make sure what kind of conditions you are in and what type of traders you are, or what type of trading style that you're comfortable with at the end of the day. Now, determining the optimal ratio, I think everyone has been talking about win rate, and I think there's always a common myth is that when you have high win rate, you're going to be successful. It's not necessary. High win, I've seen traders who have quite a low win rate, but every time the win ratio is very high. They may even have 40% win rate, but most of the time when they win quite large, but they lose very minimal. So in net, they are still winning the market. Win rate is high. Low win rate doesn't mean that you're not going to be a profitable trader. But obviously, when you should have a higher win rate eventually, or your win rate should go up, as you trade along your trading journey, because that will eventually determine whether you have the trading edge in your profile. If you don't have that, it gets very difficult. Now, if you look at the win rate and the risk to reward ratio, the higher win rate normally will always, if you have a low risk to reward ratio, you must make sure you have a high win rate as a result to compensate. Now, I mentioned risk to reward ratio is very depending on whether you are trading in a trending market or a choppy market. Now, in a choppy market, you can't have a high risk to reward ratio because the market is not going anywhere. So if you really want to try to aim for big risk to reward, especially the reward portion during a choppy market or a sideways market, it can get very difficult. And most times, if the market is not heading anywhere, there's no direction, there's no trend, it gets stopped out quite easily. So strategy is also important parameter to consider. So if you are scalping a lot, definitely you're always looking at lower risk to reward ratio. If you are trend follower, definitely you need a higher risk to reward ratio. So usually trend follower, I mentioned, you always aim for 1.5 times to 3 times of the reward against one portion of risk, because that's how you should be aiming, given the time that you're putting your position in the market. Now, that there is also a matter of trading psychology. This is where I do see traders that some traders always prefer small wins, even for 1-to-1 or even less than 1% of win. They may even try it because it gives them the confidence with their position, with their process, with their plan. So as long as they think that my plan works, it gives them the confidence, the boost of confidence, and therefore they should position themselves in the market. So this is all again a psychological play, and it's very individual. Some traders will prefer to have small wins. Some traders will always try to wait things out, to try to ride the bigger wave. So it's again very individual by nature. Now, one thing I want to caution is that if you are doing this full time, whether you are whether you're holding a long-term win or a short-term win, it doesn't matter as long as you still win. So it really depends. If you really treat this as a business, you need that income. So obviously, even small wins are important, and as many frequent small wins you can gather, it will be something that's beneficial for you. So all these are all into play whenever you want to consider optimal ratio when it comes to the risk to reward portion. Now, I mentioned again, I always mention this is all about risk. Why risk is so important? Because the risk of ruin can really affect not only in terms of the P&L, but also affects the psychology of a trader. Now, what is an important tool besides looking at the technical and fundamental per se is the psychology of the trader. If the psychology of the trader gets affected, the confidence of the trader will also get affected, and in that sense, they can't really trade well along the way. Despite they're in the right market condition, they have the right tools. The only problem that resets them is the mindset. So if you don't get your mindsets right, it can actually break a trader. So managing risk is very critical, especially for those who are new in the market. If you are someone new to trading, it's always we always caution the trader to always manage risk as the first priority. So in our firm we always practice make sure you don't lose more than 2% on a single trade. The reason why you put 2% because if you risk more, your ability to recover will be better. If you risk big, the reward can be big, but if you hit a big loss, it's very difficult to make a comeback. For example, if you look at this table, if you lose 50% of your capital as a start, technically you need 100% to break even. So that's a very big achievement. It's not easy. Now, obviously, we don't we have ways to make sure that you don't get yourself into that kind of trap. But my advice to those traders outside is that always keep your losses more as best as possible, because once you have big losses or you accumulated such a big loss, it really affects your psychology. So for example, anything that is more than 15% loss, it is something that's worth to watch out. Even 20%, anything above 20%, you should really take a break. 20% is, I'm talking about the loss in capital. So like I mentioned, 50%, it takes you about 100% just to recover. It's not an easy feat, and it really requires a lot of emotional strain on the particular trader. Now, besides all that, I think there's one important aspect that's also that's important for traders, is that the ability to keep records. I know as a start, when I started my trading journey, I always, my mentor always emphasized to us is that, regardless whether that is a profit or loss, they make sure you have a trading record in place. It can be very tedious. It is a very mundane job, but it's necessary, because if you don't have data, if you don't have trading record, you will never know how's your progress going to be. Whether it's a losing day, it's a profit day, it doesn't really matter, because in both occasions you still have to have a record of what you've done. What are the areas, what are the aspects that you should improve, and the areas that you can keep it, especially when you have good successful profitable positions. You can record that as to what you've done right. So trading record is essential, especially for those who are beginning in the journey. Now obviously when after a certain amount of experience and years, you can obviously shorten that process, but eventually you still need a trading record, because that will eventually track your progress accordingly and see your progress along the years. So these are the few key things that you need to have in the trading record. I think first thing is to look at P&L, that's for sure. Whether that day is a profit or a loss, you still have to keep a record. Second is total volume traded, just to make sure that how efficient you are. Are you taking, if you suddenly see your volumes are increasing, but your P&L is not increasing, is it you're taking your risk to reward is too tight? Are you risking too much? So these are the things that's important for us to take note on every daily basis if you are in your trading record. Third thing is always looking at equity curve, basically looking at your capital position, whether is your equity increasing. Normally that's the ideal position for a trader. You must see equity curve increasing. If you don't see equity curve increasing, that means you are not doing anything that's right. Flat is fine, it means you're not making money, but don't let equity curve comes down. If your equity curve starts sloping down, it's telling you that you're losing money, and it's worth to pay attention as to what you have done wrong and try to fix it. Now net positions are important. That will tell you whether are you holding how many positions are on your books, are you too much exposed to certain positions. Then you should trim. If you are day positions, you should trim your positions by the end of the day. If you are holding swing or not, or position trading, always review your positions at the end of the week. Now, if you don't want to take too much of a risk, especially like CPO market, you put it over the weekend. There's always something major that happens over the weekend. It could be economic news, it could be government news. That can affect your market coming on a Monday. So net position is important for us to track whether are you over leveraged on certain or overexposed into certain areas. Margin utilization is also important data, because that will tell you whether are you using too much of your capital. You shouldn't be using 100%. That means anytime you can get a margin call. You should have enough buffer just in case. Buffer in your capital account, just in case that market go against you, you still have capital to utilize to answer those margins. So margin utilization rate is very important. Now trading remarks is more on your emotion, whether each of the trades are you doing, how are you feeling? Are you feeling that you've exhausted all your skill, all your ability, but the market is not in your favor? You should write that down as well, because not necessarily every time the market goes in your favor. There's always period of time when market doesn't goes in your favor. And how do you feel that? How do you manage that? Those are key things that you should both to pay attention and should write it down or record it down, just to give you a sense of at least next time when you come across the same situation, you know what to do in a much better way. So these are example of a trade journal. Again, this is very individual. Some individual traders may not have certain data to keep it. Some may have choose other data to track. So it all depends on that particular individual. Now, for a start, I think it's important to have at least you have a date, you have a product they have trade. So, example, this is a particular trade they have taken. So important to have the date, the product, the specific product. It can be SCP or FKLI. What's the direction they've taken? The entry price, the exit price. The size is important. Sizing is a matter of also a matter of growth mindset. Once you have reached a certain level of profitability, you are well confident. Then obviously you can increase your size position. Now, when it comes sizes, there's obviously you are also exposing yourself to higher risk. So it's a balance of risk and reward at the end of the day. So stop loss, if there's stop loss being taken, or whether it's profit taken, then it's your P&L, the equity, and what kind of setup are you looking at? Is it a breakout position, or is it a sideways market, or is it a mean reversion or whatnot? So it depends on what strategy that you take at that particular point in time. And how confident are you? I think it's important for us to rate your confidence level. So if you look at this setup and you think very confidently that this setup can work, you should rate yourself, because if your confidence are high, and the trades are in your favor, that means your plan and positions are quite in line. Now, if your confidence are high but your plans didn't turn out well, then you have to relook. Is it because of market conditions that make it the trade not profitable, or is there any other reasons? So it's important for us to teach our confidence level on each of the trades that we take, and obviously emotions as well. Now, I think emotion control is very important when it comes to trading, because trading is a very rational game per se. So human beings are to a certain extent quite irrational in certain ways. So emotions can really get on top of us. It's important we always make sure we have a track of our emotions. If we are if we don't have the right emotions in place, we must make sure that we do the certain necessary steps to make sure we have that emotion, set back the emotion back into place before we actually make any trading decisions. Okay, and notes are pretty much some remarks. It's whether you think that your whole setup is good, you followed your rules, and it turned out well, then you should write it down. Even though if it's a good setup, you follow the rules, the market doesn't turn out to be the way you wanted, you also still write it down, because at least you can gather some observation why the market is not in your favor during those instances. Okay, so besides trading journal, these are some of the key performance metrics that you need to have or you need to track at least. First thing, you're always looking at net profit. Net profit is basically looking at the amount of money you make and obviously deducting all the commission and other expenses. So as a trader, if you are a profitable trader, you must have a net profit. If you are not a profitable trader, that means you suffer losses in your whole trading journey. So as a beginner or as a trader, we always aim to have positive profit territory, and it's not easy. Some people start out in the industry, they don't see money for at least a couple of months, or in fact some couple of years. So really is a tough measurement. I mean, it's a tough obstacle, and it's a tough aim to really set for a particular individual. But like I mentioned, if you manage your risk well, if you have the right setups, if you have a plan in place, eventually your equity curve will turn to positive. So that's where I really want to drill down, especially for those who are new to the market. Now, profit factor is also another important criteria to track. Basically, it measures the amount of money you make against the money you lost. So again, positive factor, you should have more winnings compared to losing. If you can have series of losses, but if the losses are small but your winnings are big, you still have a positive profit factor. So as long as a positive profit factor is a good thing, that means you're in progress. You are making money ultimately. Now, win ratio is basically looking at ratio of winners and losers. This is where it gets controversial. Some people always say that we should have a high win ratio. I've always discussed this. When you have high win rate, doesn't mean you can be profitable. When you have low win rate, doesn't mean you are not profitable. So it really depends on how you manage your losses at the end of the day. If you keep your losses small, your win rate is not good, but you keep your winnings. You ride the trend. You go with the trend. Your winnings are big, and you can cover the losses. You still have a positive profit factor at the end of the day. So win ratio can be very misleading if you just look at win ratio. You need to look at other elements, other criteria as well. Max drawdown is something that is for us is important, even in fact for any other traders, because max drawdown is basically looking at the biggest loss you've ever been through. I think that's important because there's always a threshold of pain that you bound to have, especially when you trade and you go for the longer term in this trading business. And eventually, I think not only you must understand your max drawdown, you also must understand how fast can you recover. I've seen people that they lost substantial amount, but they can recover those loss quite rapidly. So again, it really depends, on how you handle your psychology at the end of the day. It's about your mental that is more important. So max drawdown is an important element to track, and always make sure keep your maximum drawdown as small as possible. Eventually, you can't help it. You must have a period where you suffer big losses, but keep that keep the emotions during that time. Keep your emotions stable, and always think of always have the confidence that you can recover that amount eventually through the right proper planning and the right discipline. Okay, now just showing you this is looking at equity curve. So like I mentioned, you plot your equity curve on a chart. You can see that generally you should expect that your equity curve should be going up. If your equity curve is going up, that means you are in good hands. You should be on the road of profitability. Now there's always a bump. There's always a road bump. If you look at this period, this is where your max drawdown is. But eventually you should be able to recover. And once you recover, normally your mindset your psychology will be boosted because you've recovered such a substantial loss. Normally your confidence will be back up. You should trade. Then therefore you should be on the path of profitability. Now it's interesting if you plot an equity curve and if you do a so-called moving average line. Okay, I did that on my own. You notice when the moment equity curve starts to trend down like your normal moving average crossovers, when the equity curve starts to come down, normally it's a telltale sign that whatever you're doing is not giving you money. You should stop. That's a good way to track. So equity curve is one good way also to tell you that whenever you start to see there's a turn in the equity curve and it's been quite persistent, it's a sign that's telling you, you should be looking at whatever you're doing because market is not rewarding you. So equity curve is a good signal for you to actually take, especially when you notice that something is not right. And usually that's the first telltale signs of whatever strategy that you're using, whether is it still making you money or not. Okay, so I'm not going to go too much on the trade journal, but I think as a start, a lot of people find this. When I first started, I always find this very tedious. To document so much of data, to document so much of your thought process, and usually you've done this at the end of the day. You're already so tired from trading, and you have to do this to pen down all your thoughts. It's not an easy task, but you have to do it because once you have accumulated a lot of data about your performance, you're able to understand yourself better. You are able to understand your trading processes even better. Now, like I mentioned, once you've accumulated years of experience, experienced traders would probably skip a few steps. They just keep certain key important data, and even some of the remarks they just put a simple remark. That is after years of experience. So it's important if you are new, in this business, in the trading journey, you have to really pen down every single thoughts that you have when it comes to your trading profile, trading processes. Now, always observe this. The moment your equity curve starts to change, normally it usually coincides with market sentiment, market trends as well. So that also will tell you a little bit on whether your strategy works with the current market scenario. If it doesn't work the current market scenario, normally your equity curve will start to come down. That tells you are not profitable. So whatever strategy you're using, you really have to take a bit, or you have to use, you have to stop your trading for a while, wait until the market is more in your favor before you start trading again. So understanding, observing all this equity curve, your profit factor gives you an indication as to whether are you doing very well, especially when markets are changing. Okay, so I mentioned this. There's some of the key parts of journaling. These are other areas as well. You can also remarks on the market. Whether the market is it making higher highs, higher lows. Taking down the highs and the lows of the day. Also do intra-market analysis, looking at where, if you are trading CPO, you look at Thailand palm oil prices, are they making new highs? You also look at soybean oil, are they making new highs? So, putting all this into data, you probably will get more. If you put it on a spreadsheet, you can roughly see how they are correlated, and in probably you can create certain strategy out of it. Trade analysis, this is the key one. I mentioned earlier how many trades were done. These are mainly looking at volume, decision for each trade, results for each trade, and the emotions involved. And the key thing when you use remark, I always get this a lot, is we always look at things on the third party point of view. Don't do that. I think look at things on the single party point of view. Look at yourself as the person, because from there, once you start, you feel that you are accountable and responsible for your actions. If you use a third party, you are in a way pushing the responsibility to other party. But ultimately you are the one that making the decision. You are making the buy and sell, so responsibility should be on your hand. So try to, you're putting remarks, you're putting or penning down your thoughts. Always use the first person principle rather than third person principle. Okay, so personal growth and self-improvement is key. I always mention this. Trading journey is not an easy journey that you can get it overnight. Overnight you become an instant success. It's not that simple. There's a lot of planning, there's a lot of hard work, there's a lot of processes that is being involved. So personal growth and self-improvement is very necessary. That a setback doesn't mean it's the end of the world. Even if it's a win, doesn't mean it's going to be always winning. There's always a period of time where the market doesn't always work in your favor, and that's where you really need to dive deep down and to look at things beyond looking at things, trading as objectively, but looking at trading as more subjective. So that's where a lot of personal growth will be needed, and self-improvement will be needed as well. Okay, so now after discussing all this, how important is trading psychology? Now, trading psychology is very important. There's a lot of surveys that says that the attribute of trading psychology contributes roughly about more than 50% of trading success. You look at fundamental or technical or risk management, if you combine all those, they're probably only giving you 30 to 40%. So the bulk of it is still the psychology of a trade. So that shows you how important it is for someone. If you want to be successful in trading, you must get your trading psychology right. Now, here are some of the famous authors. I'm not going to mention. If you have read some of their books, they always talk about trading psychology. So, like for example, Mark Douglas, the author of Trading in the Zone, he accounts 80% of trading success down to psychology. Even Alexander Elder, also another great author when it comes to trading, he accounts 60% the importance of trading psychology for trading success. Wen Tup, if you have not read Wen Tup books, I think it's a must read if you are new to trading. He mentioned it's about 60 to 80%. So, trading per se is easily more than 50% of trading success. So once you get your trading psychology right, normally you really win 50% of the battle. So it's important to always make sure you have the trading psychology right in place beforehand. So these are some of the truths or fundamental truths about trading. I always stand hold to this. I think first thing is that always believe the notion that anything can happen. Don't have the mindset that it's pretty fixed. I've done my analysis. This is how the market is going to react. No, the market doesn't always react in that way. So have that adaptability in mind that anything can happen in the market, and be adaptable. So, for example, if you are using a trend trading strategy, Don't expect that, oh, market is trending, I will stick to my trend trading strategy. So be adaptable. If the market showing you sign that the trend is not in place or the trend is exhausted, you have to be adaptable to use other type of strategy, or even if you are holding to trend strategy, you got to change. So always be prepared that anything can happen in the market. And the second point is that you don't need to know what's going to happen next in order to make money. This is very true. There's always a saying, we try to outsmart ourselves too much sometimes. In a sense that we always want to know what is going to happen. We always want to step up to the front. The key thing is that market is very variable, dynamic. You can't know what will happen in the next second. So the key thing is that you don't need to know. You don't need to put so much analysis to what's going to happen. Just trade with what that's currently is happening at that point in time, because that's eventually is more important. So I think that you have that, you keep that frame in mind. Normally you'll do well. Now, if you look at over the age of some of the successful traders, the distribution between wins and losses are actually quite fair. That means they have a fixed amount of win, pretty much 50% of win and 50% amount of losses. I think what is key to them is that when they are winning the market, especially those who have the edge, they really ride with the market. Means whether they will size up, they will increase their position, especially when they are winning. And when they are losing, they cut their losses fast. So this is an area where a lot of people will find it very difficult. The ability to cut loss is really a skill, and a lot of people don't get that. So a lot of people who always think that, hey, why I can't be successful in this, is because the ability to cut loss is always something that they find it very painful experience. So I think ultimately, risk, ability to cut loss is two major key things when it comes to trading. Now, an age is nothing more than an indicator of high probability. That's true. It's always, if you think that you have a trading age, it's still a probability, or even it's an odds. It's never a sure thing. So always make sure that if you have a trading age, the trading age can only last until the market market environment persists. If the market environment changes, your trading age may actually erode over time. So it's important that again, an age is just a probability, and eventually the probability can decrease, and it's time for you to look at other trading age. Now, every moment in the market is indeed very unique. Every downtrend, every uptrend itself is very unique. So always be in a position where you are highly flexible, you can adapt. The market change, you're also changing along. Okay, so what's trading psychology? It's actually down to mental and the emotional aspect of the trader. So eventually, I think this subject can be very subjective in nature. It's very individual, but I would say this, if you want to boil down to what psychology is really looking at the mental and the psychological behavior of a trader. And these two things are very important. And as mentioned, is contributing easily more than 50% of a trading success in most traders. Okay, now the major difference between I get this a lot between trading and analyzing is that a lot of people say, oh, I analyze the market. Now, analyzing is very different from trading. Trading is basically looking at, you're putting a positions in, you are looking at the market, you make a decision. Analyzing, you can just analyze, however you want, whenever you want, but if you're not taking a position, you're not putting your conviction into action, it's not going to be fruitful. So I think it's a good position. A lot of, that's what Sulian has mentioned earlier. Apex at this platform, this derivative platform challenge that if you are new to the market, you can analyze how much you want. You can put up your plans. You can have a plan in place. But if you don't put that into action, it is always analysis that you are doing. It's never about trading. Trading is putting your analysis into action. So that's a major difference. And when you actually trade in the market, even though you get this a lot, as a start you always try to trade the market using paper trading or simulation account, because that will give you at least a so-called as good as a reality as it can be as to how trading works in the real world. But eventually you really have to transition yourself from simulation to the real world environment, because that's how you really improve. eventually, and because that's where your psychology will be very tested. If you're on simulation, your psychology will be out of whack because there's no real element of risk taking. But when it comes to the real money in the real world situation, there is more risk management that's in place, and that's more critical. So always have this. It's good to be on simulation as a start, but eventually you really have to move on. I would say it's a good start. It's a good platform to always start yourself in simulation because that's where you practice. But once you get it, it's time for you to move into the real scenario. That's by opening an account, putting money in, and start trading. So that's the major difference between trading and analyzing. Okay. Now I'm just going to touch on a little bit on some of the biasness, mental biasness, which I think it will it affects a lot of traders. These are some of the key ones. FOMO, fear of missing out, is a very real. Especially those who are, if you just look at some people are people are talking about people are jumping into crypto, into Bitcoin and whatnot. If you are not in it, you're really missing the crowd. So there's always this fear of missing out. It's an important biasness. If you don't do analysis beforehand, if you're just jumping because you don't want to be missed out, that's a very dangerous proposition. So it's very common if you are trading. FOMO is a very common fear. Common mental biases can actually afflict a lot of traders. Now, I think emotions, this is something that trader have to deal with every single day. Now, emotions, whether it's in the market or out of the market, is still emotion. So now, as a trader, emotions control is always important element, important driver when it comes to your trading processes. Now, failure to follow a trading plan down to discipline. So again, one of the common discipline, I would say discipline areas of weakness is that I mentioned about the need of journaling, and a lot of new traders, because of the find it very tedious to do it, they usually skip, doing journals in the beginning of their trading years, and eventually that will bite them because whenever they want to find areas of weaknesses, they can't because they don't have the data, they don't have the trading record, to find areas that where they can improve. So that is important. As you're beginning couple of years in your trading journey, the first few years is very vital to keep your trading record accordingly, because that will give you an arsenal of where you think your areas that you can improve and areas of your weaknesses. Then doubt in your own abilities, this is a killer, because like I mentioned, what kills a trader is always the confidence. If the traders are not confidently enough they don't think they can recover their capital, they're always be stuck in that mental trap. So the easiest way is don't get yourself into that trap in the first place. So make sure you have your risk management in place, keep your losses small, don't fall into the trap of a big trap, a big failure trap, because it takes a lot of effort to recover, and to do that you really need a lot of mental strength. So doubting in your own abilities, doubting your own confidence is very crucial. Once you have that, normally you are in a spiral downwards. Usually we advise our traders, don't go into that kind of time. Don't go into the kind of mental frame, because once you're in there, you can spiral out of control, and really you can ruin your career, your trading career. So negative mindset is another one. People sometimes, usually they have a preconceived mindset when it comes to before they come into a trading journey, and because of that, they are holding to a preconceived mindset. Sometimes can be weighing down on their mental frame. So having negative mindset, especially I would say is sticking to a certain position, sticking to a certain conviction, or in other words, stubbornness can be leading you to a negative spiral downwards, especially when it comes to your mindset as well. So negative mindset is something that you really have to control, especially when you're doing trading. And keep in mind, trading is a constant decision that you have to make every single second. And when you have a negative mindset that's in place, you can't really make good decisions when you have negative mindset that's afflicting you every single moment. So it's important for you to control that negative mindset. Okay, so these are some of the psychological pitfalls. I'm not going to go too much in it, but fear and greed is very common. The market is driven by fear and greed. So as long as there's fear and greed element in the market, there's always a market to trade. So keep in mind, in trading you can't be too fearful. If you're too fearful, you can't make good decisions, and you also can't be too greedy. If you're too greedy, you're just exposing yourself too much of a risk. It's always a balance between fear and greed. That's why I say, it's trying to rationalize irrational human being. It's never easy. Okay, the next psychological pitfall is overconfidence. Now, this one is very common, especially for new traders. I've seen a lot of cases where traders who come in, they trade the first few subsequent trades, they make good money, they think, and they get overconfident, they put up even bigger position in the next couple of trades, hoping that whatever they thought as the plan or strategy works, it will continue. Now, market is dynamic. Like I mentioned, whatever you have planned in place, market doesn't always flow according to your plan. So there will be bound a period of time where you tend not to do well, and when the moment comes, and if you are sizing up in a very big position, you can get if you don't have proper risk management in place, you can get out of control very fast. So overconfidence is very common for new traders, and as I advise, don't go into that kind of scenario. If you feel that the first few subsequent trades are successful, always keep your emotions in check. Make sure that whatever you're doing, rationalize it, and leave emotion aside if you can, and look at things objectively. Now, this again, confirmation bias is also another mental bias is very common. If you have a fixed mindset, for example, if you have been looking at things, whether it's if you've been trading CPO, you look at things fundamental. If you always think, supply is coming back, seasonality and whatnot. So you always think that you always find news that just to confirm your view that the market is going to head to further downside because the supply is coming back. Now, if there's any news to say that probably could be a weather in play, suddenly will affect the supply, that because of you holding on to that biasness, you probably want to tune out those news that will affect your view. And when you have this kind of so fixated view, it's kind of dangerous because when market tend to, or whether market fundamentals change, normally it usually reflected in prices, or normally prices will react faster than what fundamentals per se. So that's where a lot of traders will get caught if they're too conform to their biasness when it comes to their views. So importantly for a trader, always make sure you have that flexibility and adaptability in mind. Whenever market situations change, you also have to adapt accordingly. Now, loss aversion, this is what you're facing. It's always, sometimes when losing position, we tend to hold. And the ability to, like I mentioned, one of the key success for a trader is the ability to cut loss. And a lot of people as a start, they always find cutting loss very painful experience, but it's necessary. If the position is not in your favor, if you're going against the trend, there's no point for you to stick to the trend. You should be out of the market. If it's against your plan, if there's a plan to stop loss, you stop. You get stop loss, that's it. Look for the next opportunity. Market, there's always opportunity abound. But always make sure that if you're not in the right position, if the market go against you, get out of the market as fast as you can, using your stop loss measurement. Don't hold into losing position, hoping that the market will rebound according to your position eventually. That's a very wrong mindset to be in, because eventually the market can trend against you for a long period of time and can actually wash you out. Ultimately, you'll face your risk of ruin and you'll be out of the market for a long period of time. So important, always make sure try to keep your capital in check, and always make sure you always have a loss management in place. Now, anchoring bias, again, very common. Like I mentioned, is again biases where you just want to hear views or comments or opinion that's aligned to what you have anchored with. For example, if you're thinking FKI is going to do well, because of certain news, you just want to find elements or opinions from other people that actually confirm your bias. You want to tune out other people that's holding against a different view. So, being a trader, you really have to be flexible in that sense. You can't be too stubborn to hold a single view. Then eventually the market will reflect on your decision quite badly. Now, groupthink is a very common biasness as well. This is where because of your analysis or people's analysis, it actually convinces you to be also part of it. So for example, if everyone is talking about, FKY should perform well or FCTO should perform well because, a supply is shrinking, or foreign funds are coming into Malaysian market, everyone is longing futures contract. Why are you still shorting? And because of that view, it influences you to also take a position in it just because of what other people is doing. So group think is a very dangerous thing. You don't put on your own analysis, you don't take it further. Just because of what other people is doing, you are influenced by that. It's a very dangerous proposition. So this group thing is a very common theme, especially for those who are very new to the market. Now ostrich effect, same thing. This is even worse. It's actually tuning out all the negative information. So it's very selective. So you're only choosing pieces of news that actually conform with what you think. Any news that is against your view, you don't want to accept it, and it's very dangerous because opinions or news that is if you're choosing it very selectively, you don't look at the overall picture. Sometimes the market can move in certain direction very rapidly, and you usually get caught off guard, and you'll be explaining yourself why is this happening, just because you're tuning out certain information that's very vital to explain why the market behaves in such a way. So it's important to always have a well-rounded view of the market. Be attentive to also other news sources or even other opinions. Okay. Now, other common psychological challenges. Again, I mentioned fear of missing out, fear of loss. Now, revenge trading is a very big part. I noticed this and I observed this even to myself in certain extent. Revenge trading, normally happens, especially when you suffer a big loss, and because of the big loss, or even for a fact that market go against your view, and you have done analysis, you have pretty much quite stick to the view that your view is correct, but the market just go against you. So because of that, you want to take a revenge from the market. Now this is a very deadly proposition. Now that's why it's important in your journal to always remark this. The moment you sense that you must acknowledge that whether whatever you're doing, is it for revenge trading. If you sense that kind of thing, you should immediately try to tone down your trading decisions, because you're putting a lot of emotional involved rather than looking at things more objectively. So overconfidence is another one, but I think revenge trading is a much bigger mental aspect that you really need to address if you encounter this. Now, analysis paralysis, this is very common for new beginners. With so much influx of things that's coming, or a lot of data that you can gather, a lot of YouTube channels that you can watch, or there's a lot of analysis that you can do, but a lot of analysis doesn't mean that you're going to result in a good profitable trading manner. So it's bound to have analyzed too much. You're going to be paralyzed by too much of information, and ultimately you can't make good decisions. So keep a balance. Always make sure that what is important, tune out those that's not important, and eventually, once you traded long enough in the market, you probably get a sense of what is important to track, and what is not important to track for a particular market. Now, impatience is also one thing. I think a lot of people is that the moment they want to put in a trade, they should see the result immediate. Now, markets doesn't work that way. Sometimes it requires patience. So impatience can be an important hindering factor when it comes to especially when trying to write the trend. So trend doesn't always show in the market immediately. It takes some time. So impatience is a common element, especially you look at challenges, psychological challenges in trading. So how to overcome? I think it's important that you must have a good variety of information sources. Try to avoid too many or too relying on too much information. So I believe like Apex, if they have the daily report, I think that's sufficient. Those reports that circulate out, I think they filter out what's important for the audience to really understand the market. If you're reading too much, basically you're going to have analysis paralysis. So, keep your factors to what is driving the market. Then always believe is that whatever opinions you listen, think it objectively, and take it on surface level first. It doesn't mean that whatever people say is always the true fact. There is always something that is lacking, or certain certain structure that's being not analyzed in thorough. So there's always something that's lacking in a particular sense. Now, keep good records. I think this is important. I mentioned journaling is an important part for a trader. So with meticulous records, you can roughly identify what are the areas that you need to improve. So, for example, if you're overconfident, then you should tone down your overconfidence. If you are too much of having anchoring bias, then you should adapt. Don't put too much emphasis on certain biasness. So having a good record will keep you on track. Now, get peer feedback is a good environment. So if you are trading in a trading community with other people that's also trading with you along as well, you can exchange feedback between each other, and I think this is a good environment to start off with, because trading can be a very lonely journey. If you are trading in a community, it's a slightly different scenario. So you have someone that's over watching you, they can have a better perspective, or they can see a different angle compared to what you're seeing yourself with. So they can give you a feedback from a third party point of view, and that will actually helps you a lot when it comes to giving you a valuable feedback. So I think these are the areas that you can help to minimize such biasness along the way. So what matters most, just to reiterate, Alexander Elder mentions this: the goal of a successful trader is always to make the best trades. Money is always secondary. The primary thing is always get your plan, your objective right, then eventually the money will come. So managing risk, again, I have emphasized this many times. Trading is all about risk management. Once you implement a proper risk management in place, your age of profitability will be higher, and that's very essential for a trader. Okay, so manage your risk by risking an amount that you won't liquidate your account even after 10 consecutive losses. So that means you must have a big buffer and always put capital that you're willing to risk. If you're putting a capital that you're not willing to risk, you shouldn't be doing trading. Then eventually, you must have a plan in place, especially stop loss plan. So never go into a trading action without having a way to stop your losses in case the market go against you. If you do that, you're exposing yourself too much of the risk. And always remember this: don't do revenge trading. I get this a lot. A lot of people will say, I've done this first time, I revenge trade the market in my favor, I recovered my capital. That's not the right way. What happens if the second round comes in, you do revenge trading, and the market go even worse position, then you'll be out. Okay, trade management. Trade management, I think I mentioned this, is looking at your risk to reward ratio. So I'm not going to go too much on this. You can obviously go through the table I mentioned earlier. So trading rules, I think most of the trading rules always emphasize on loss, losing trades. So it's never about your winning trades. It's all about executing your losing trades. So I mentioned this. The ability to cut loss is very important. A lot of people don't want to hear this, because people always say, I want to hear how to be profitable, but you never want to understand how is matter more on the way for you to, the ability for you to get yourself out, to cut your losses fast, especially when the market going against you, because that is more important. That keeps your survival, your survivability in the market. That eventually your trading success will come. Okay, so I'm not going to go too much on emotions because I covered this, but I just want to mention this, because I get this question a lot. What it takes to become successful in trading. Now, I always equate trading like a high performance activity. For example, I think there's a saying. If you look at Steve Watt, if you read his book, he equates trading more like high Olympic performance or Olympic performance. So traders are like Olympic performance. Now, Olympic performance, they have to be top of the top. They have to be their best every single time. So whether it's a down day, up day, doesn't matter. They have to approach every single trading day or every single training day as a new day with their best. Same goes for traders. Traders will have to come in, they have to approach the market every single day with the same rigor. So, I think it's important to look at trading as a high performance activity, and to do that, you need to have the mental strength, the mental resilience. Because if you don't have that, the mental resilience, you can easily break down when the market goes against you, and that could be a dangerous preset, especially for when you're facing a volatile market. So I think people always equate this. Traders are always they get this a lot on watching YouTube. They always see successful traders driving nice cars, trading at a fancy location, trading at the beachfront. The truth of the reality is not. Trading requires a lot of preparation, and the mental frame is very important, and it's the most important aspect out of it. So there's a lot of routine, there's a lot of training processes that's involved before making the trade. Same goes for like an Olympic performer. They go a lot of training, they go rigorous training, they have a disciplined routine they have to follow. Same goes for traders as well. So trainers and Olympic performance are very similar. So imagine this: you want to be an elite trader. You have to imagine you want to be an Olympic performer. You got to be the top. You got to be the best. So that's how that's why trading requires a lot of high performance effort. So therefore, mental agility is key. Is important. And Steve Watt in his book Bulletproof for a trader, I think it's a very good book if you want to start learning about trading psychology. That's a good book to start off with. I think he mentioned this very well. The mental aspect is very key. The agility part is very important. Okay, so I'm just going to, these are a couple of books that usually I go through. In fact, in the company that I'm working with, one of the key books that we always recommend our young traders is to read this book called One Good Trade by Mike Belafore. I think he spells out very well on how competitive it is, especially in the trading world. And if you are trading on your own, it's a very tough proposition. So if you are trading in a community, it's a good start. So find a community or people or traders alike that you can accustom with and trade alongside with as well. Dr. Alexander Elder, The Trading for a Living, is another good book talking about a lot about trading discipline and risk management. So Jack Swagger, if you are in trading journey, you must read his books. It's basically telling stories about how other successful traders have actually been doing it well. And as a successful trader, you want to emulate those traders. So now, Dan Newman is not talking about trading, but it's talking about the way of a mental mind frame. So it's the way of the peaceful warrior. So go check it out. There's a movie on it. It really tells about how important it is to have a right mental mind frame, especially when you're doing a high performance activity like trading. Okay, so trading is sort of about performance. So therefore, it gets a lot. It's very subjective in nature to a certain extent, and it requires a lot of effort, which a lot of people don't see it. But the behind action is actually tremendous. So that's why it is important. That as a trader, we really need to recognize that success. There's definitely no shortcut. And I think what's important for a trader is that it's not a one-time profitability, it's a consistency. There's no point, you make a big amount of money, but it's not consistent. You need to make it this month, but the next couple of months you don't have the right strategy to make those gains anyway. So consistency is a big deal for a trader. So if you are new to trading, I think that's where it's important to look at consistency as a start. Now, if you really want to consider trading as a career path or as a journey, these are some of the key things I need to ask yourself. Always ask this: are you psychologically prepared? Can you handle daily stress? Now, trading stress it is surmountable. It can weigh on you heavily, and that's only regarding your trading stress. You still have other stresses in your life that can also affect you. So, whether are you psychologically prepared for that? Now, financially prepared is also an important question. If you plan to do this full time, you must make sure that you must have a list of what your current commitments, because trading is not instant success. Doesn't mean that next month you start, it's going to be a profitable month. They're bound to have months where you don't make money, and what happens if in those months you don't make money? And how is that going to affect your commitments? So financially prepared is a very important question you must ask yourself if you are thinking to do this full time. So obviously, do you have a trading age? If you don't have a trading age, there's no point to talk about trading, because if eventually you have no age, eventually you don't make money, and there's no point to do trading if you don't make money. Okay. And is it a lifestyle I want? Now this is an important question. I think a lot of people have this preconceived notion that when it comes to trading you have a lot of free time. I can tell you it's far from the truth. If you are starting the journey, if you are new to the journey, in the beginning years is a lot of effort, a lot of time you got to spend. Even after markets, you got to do a lot of mental work. And before market opens, you also have to do a lot of mental work. So the amount of hours you put in, if you are new to the trading journey, is a lot. So don't expect that because of what you've seen in YouTube, all these people are so successful. They always have free time. Just trade for only 1 hour a day and that's it. No, I think in reality there's a lot more things than that. A lot of preparation work that need to be done, and therefore there's a lot of time requirement along the way. So I'm just going to end here. I'm just going to hand it over to Suling for any questions from the audience. Yeah.
All
Over
right.
to you, Suling.
Thank you, David. Thank you for the great session. And I would like to apologize again to the speaker and audience. Due to some technical issue, we start late today. So yeah, I think we still have a little bit of time. I'll try to open up like 2 to 3 questions to the floor. Let's see. Yeah, I think I saw some questions already. Okay. Wait.
Sure.
Okay, David. First questions. Let's say I've entered a positions and the trade is go in my favor. So I'm looking to add on that positions to ride the upside further. And then David, how would you approach adding on to a winning trades, and where would you suggest the setting the cut loss level? Should it be based on the overall portfolio or based on just the additional lot? Yeah.
Okay, that's a good question. I mean, covering on sizing position, it can be a very lengthy topic. But just to answer that question, now if the trend is right, if the technical trend is still in place, whether it's Heiken actually is still green bar, bullish crossover, DMI, ADX is still rising, you should be adding, in the next, if you're looking at 30 minutes, in the next 2 subsequent candles or in an hour, the market is still uptrend, you can add your position accordingly. Now there's a trick to it, and there's a strategy to it. So I would say this: as long as the trend is still uptrend, you're holding a long position, you can add along the way. But be careful once the trend is ADX is showing you that the trend is exhausted, you should be cutting your position or trim down your position as fast as you can, because you're holding a bigger position. So that's one area that you can look at. Now in terms of controlling your loss, if you have a bigger position, you can use still back ATR levels, or you can move your stops into a higher level, just to make sure that to secure a certain profit for your earlier positions, and your later position you're willing to lose a certain amount, so you move your stop accordingly. So I say this, it all really depends. 2 things. I think first thing is that how are you gonna? Is the trend is still continuing? If the trend is still continuing, you can size up accordingly. And second thing is that how you will manage your risk. As I mentioned, your new positions should be just adjusted accordingly once you added those new positions.
Do you think this kind of question, if want to in more detail, it will be good one-to-one coaching?
Yes, yeah, definitely. I think you need someone to. If I want to do it, I have to show it to you.
Yeah.
In order to get a better picture. But sizing is a very different strategy, because it can help you to gain more, but it can also help you to lose more because of your size with position.
Yes. Alright, thanks. And then next question, we receive interesting questions. It's about the lifestyle thing. Okay, so we have participants are interested on what is your daily routine as a trader, like what time you wake up and what you do first when you already settle down your morning's routine. And since I saw you also involved in the CME trading, so how you manage the night tradings, morning trading, and how you manage your lifestyle. Yeah, this is very
that's a
personal.
very good question. It's not easy. First thing is that if you do the CME markets, which is very active at night, normally you have to sacrifice something lah. So normally you don't either the FKLI you probably miss the opening, or even CPO sometimes you miss the opening. So it's a balance that you got to play. Now in terms of routine, now I think normally if I'm trading on a night session, probably I will not. I need to take a rest. So if I can get out my position by 11:30 or 12, that's it. I know certain markets are very active beyond 12 a.m. Malaysia time, but I don't recommend that because that would take a lot of toll on my body. So normally I will not want to. If I can close my positions early, I'll just close. That means taking lesser profit or whatnot, I'm fine. Or in fact taking a small loss position, I'm fine, because it's important for me to have the right mental frame the next day. So in terms of daily routine, I think in the morning, if I'm able to, I'll probably do the FKR opening. If not, then I'll just focus on the FCPO opening. So before that, normally you probably be looking at your trades, overnight trades, and what have you done, and just watch on certain intermarket analysis. How is Thailand doing? How is bean oil performance last night? Then is there any watching a news, whether it's on Bloomberg or what? Is there certain news that that's can affect the market? So that's usually pre-market checklist. Then during the markets, normally you just journal accordingly, like any setup that you notice and you observe, then you should be doing. Then obviously post is the one that's most important. After you've done the market, when market closes, then you really look at through all your daily trades that you've done. Then really journal it accordingly. So that's usually be some of my routines, key routines, especially when I trade the market.
Okay, thanks. Okay, we have now we take the last questions. So we have a quick question from the floor. Someone is asking about gold and crude oils. Do you mind to briefly sharing your current view on these two markets, especially during this period, the tariff and Trump?
Okay, this is really based on my personal opinion.
Okay.
Now when it comes to oil, I would say this: Trump is an uncertain factor. Now you just look at where bonds are behaving. It's as though recession is coming, or rather stagflation, stagnant economy growth, but inflationary environment. In this type of environment, normally oil will not do well. So the outlook of oil is I would say probably it's going to be within range, but don't expect it's going to have much upside, because as long as the economy is expected not to do well in the second half, given with all this Trump factor, possible recession in place, and the tariff war, it's going to bring a lot of pressure on oil prices. Now for gold, I would say this: the trend is still an uptrend market. As long as it doesn't cross below 3,000 psychological support, it is good. But fundamentally, it's still very bullish, because China has been buying a lot of gold. For whatever reason it is, China is buying, and once China is buying, they don't buy small, they buy usually quite large, and that's supporting the market. But eventually, I have a feeling, this is my own personal opinion, that China eventually will slow down, because they're also very price sensitive. If gold prices will go up too much, they find it that's too expensive, they wouldn't be buying more gold. So that's where you start to see that prices may peak, or even in fact see a bit of correction. So I would say this: probably any attempt for prices to fall below 3,002 or 3,001 consistently, that means gold is possibly facing a pullback, and it's a good time for you, even if the trend is still uptrend, to take a long position. Now if it goes below 3,000 and it's consistently staying below 3,000, that tells you a different story. That means the gold market is quite exhausted. Now the fundamental factors is supporting the gold market for now. It seems to be very positively. You have a market where eventually the market, you have geopolitical tension, you have tariff war, you have Trump, all this uncertainty. Is actually good for gold prices in the longer run. So longer run picture, as long as all these elements are there, gold prices should do well. But I think in the short term wise, it's all basically looking at central bank demand for now. If central bank demands are not lifting higher prices, then we will have an issue. I think gold prices may face a slight pullback, and that's where technically it will be a good opportunity to take a position. So that's my opinion on gold and crude oil for now.
I understand. So just a reminder to everyone that there is a personal opinion of Mr. David Ng. So please judge your risk before you enter the market. Alright. So
Yes.
I think here's almost the end of the Q&A sessions, and just a quick commercial break here. And for those who don't know, we are also offering access for the foreign futures products, including gold, crude oil, and also soy oil. So if you're looking to diversify beyond the local markets and don't want to miss the chance of this tariff move, feel free to reach out us and ready for your trading account. Yeah. And also that is a wraps up sessions of our Q&A. So thank you for all the great questions and engagement. So please allow me a little bit of time to do a closing. Let me share my slide here. Okay. Alright. This one to... Okay. So before we end, just a quick reminder that you're not alone in this trading challenge, and we have prepared plenty support for you. So join our Discord trader community to share thought and discuss the market, and also access our recorded webinar anytime. Yeah, this is the Discord channel. And next, here's our Apex Security YouTube channel. You can replay back the important information that you have missed out before. Also, you can book a one-on-one coaching sessions, so 1 hour sessions for personal guidance. So here's our contact number by appointment. Right, next, and now this is the moment we have been waiting for. Let's take a look who is the leading the pack as of yesterday closing. So our leaderboard is updated in daily basis after the close of yesterday's sessions. Then today's session we will have a new ranking. So here's come the leaderboards. Let's see who is our top traders are. Okay. Alright, moving to the next slide. Okay, and this is our derivative dealing support hour and the phone number and email. So you have any questions, please do not hesitate to contact us. And just like that, we have come to the end of day 5 of the webinar series and the final sessions of our Apex Derivative Trading Challenge webinar series. And it's been a great journey learning and growing together over the past few sessions. A big thank you again to Mr. David Ng for his insightful sharing today. Okay, so don't miss your chance. Everyone, just don't miss your chance to grab the exciting prize and show off your trading skill. This is your moment to shine. Thank you for being the part of this journey, and we wish you the best in your trading challenge, and see you all in the tops. Alright, thank you and good night everyone.